Bonds are often considered boring, the beige cardigan of investing, as it were, suitable only for your grandmother's investment portfolio. And in a period of low interest rates and strong equity returns, it's easy to fall into the trap of ignoring bonds. After all, who wants to make 1.82% on Australian government bonds when you could have earned 9.17% over the past decade in equities? But to focus solely on return without an understanding of the portfolio construction dynamics is to miss the point and could turn out to be an expensive blind spot, particularly for young investors without the visceral memory of a deep and prolonged downturn. I'm Vince Scully and you're on This is Investing. So let's start with looking at, well, what is a bond anyway? A bond is simply an IOU. An IOU in a parachute perhaps, but this apparent simplicity hides a fair bit of complexity. So yes, a bond is a loan by an investor to the government or a corporate. In effect, it's a promise to pay a regular amount as interest or coupon and to repay the principal or face value on maturity. Historically, the rate of interest based on the face value was fixed, and that's why they became known as fixed income or fixed interest. More recently, we've seen a little bit of growth in variable interest rate issues, but they still make up a very small minority of the market. And these are primarily in the asset-backed market, which we'll come back to later. Before the development of electronic trading, the bond certificate included some detachable pieces of paper which were presented to the paying agent in order to receive the interest payment. And these were known as coupons. And today we still call the interest payment a coupon. So a bond will have a face value, which is the amount that the issuer is obliged to pay back on maturity. It will also have a maturity date, that is the date on which that face value will be repaid, and it will have a coupon or interest rate. This is expressed as a percentage of the face value of the bond, and it's usually paid twice yearly. So a 5% bond will pay $2.50 for every $100 of face value twice a year. If the prevailing market interest rate for that period is below 5%, an investor would be prepared to pay more for the bond than its face value. If interest rates are higher, they'll pay less than the face value. So over time, as interest rate changes, the value of your bond changes. The longer the period to maturity, the more sensitive the bond price is to changes in market interest rates. This is referred to as duration, or more usually modified duration, which takes into account the timing of the cash flows. Modified duration, usually expressed in years, is the price sensitivity to interest rate changes. So a modified duration of 10 years will see the price change by 10% for each 1% change in market rates. And market rates are usually described on a yield curve. So the yield curve is a plot of interest rates for each period to maturity, usually from overnight to 30 years or more. And generally, the longer the period, the higher the rate. That is, so a normal yield curve slopes upwards over time. At the time of recording, for Australian government bonds, this is 3.97% for 1 year, 4.14 for 3 years, 4.3 for 5 years, 4.75 for 10 years, and 5.27 for 30 years. Periods less than 1 year are usually priced off the overnight rate, which is very closely tied to the Reserve Bank rate, and the bank bill swap rate, which is a measure of how banks can borrow from each other. So rates for lower quality borrowers are then priced off this curve with a spread or credit margin added to compensate investors for this additional risk. And the spread will depend on the credit rating of the borrower. There are three main credit rating agencies: Standard & Poor's, that's the same people who publish the S&P 500 and the ASX 200, Moody's and Fitch. And these ratings range from AAA, the highest quality, to D for default. The lower the rating, the higher the spread you should expect. Anything above BBB- or Baa3 for Moody's is considered investment grade. Anything less than that is considered junk. Australia is one of a handful of countries with a AAA rating, along with Singapore, Germany, Sweden and Switzerland. The USA is AA+, while the UK is AA. Within Australia, the only state with a AAA rating is West Australia. New South Wales, South Australia and Queensland are all AA+, while Victoria and the ACT are AA. So your return as a bond investor is then made up of the coupons received and the capital receipt on maturity, or the difference between your purchase price and your sale price if you don't hold to maturity. Bonds are either issued in the primary market by the issuer, often with the help of an investment bank, who may also underwrite the issue, that is, promise to buy anything that isn't bought by the market, and sometimes to guarantee the rate of issue. When the Australian government wants to issue a bond, the AOFM will hold an auction. These usually happen a few days a week. They'll offer a single bond in each auction. For example, December 7th, 2025, the last auction for the year, the AOFM offered $1 billion of 4.25% bonds maturing in October 2036. So that's just short of 11 years. At the time, the prevailing market interest rate for that length of bond was 4.73%. So the auction cleared at this price and the government received $963 billion for the $1 billion of face value. This gave the purchasers $4.25 annually for every bond they bought at $96.30, which is a running yield of 4.4%. They would also receive $100 of maturity, giving them a return to maturity of 4.73%. That's how it works in Australia, but most overseas countries run similar auctions. Now, there are other types of bonds. So far we've looked at long-term fixed-rate bonds, and they're the vast majority of the market. But there are three other major categories. Treasury index bonds, which are medium to long-term, so that's 5 to 30 years, where the capital value of the bond is adjusted for movements in CPI or inflation. Interest is paid quarterly, unlike a standard bond, which is 6 monthly, at a fixed rate on the adjusted capital value. So every quarter, the capital value is indexed to inflation and interest is paid at the fixed rate on that amount. At maturity, investors receive the adjusted capital value of the security, that is the value adjusted for movement in CPI over the life of the bond. Now, the difference between the rate for TIBs and normal bonds tells us the market expectation of future inflation, the so-called break-even inflation rate. And that's a good way to track where the market thinks inflation's going. In the US, these are known as TIPS, or Treasury Inflation Protected Securities. And they're really attractive to insurance companies who have got long-term inflation-linked liabilities. The second big category, and if you've watched The Big Short, you'll know what this is about, is asset-backed securities. Now, these are bonds representing pools of underlying loans, such as mortgages or car loans, in a process known as securitization. These usually have a floating rate, and it's usually tied to the bank bill swap rate, which closely aligns with the rate payable on the underlying receivables. So your mortgage varies along with the bank's cost of funds, and so that needs to be passed through to the bondholders who bought these asset-backed securities. When borrowers make payments, these are passed through to the bondholders, meaning the maturity of the bond is variable. And this creates pricing challenges and also opportunity for active managers to generate excess returns. And the third major category is floating rate notes, or FRNs. These are usually priced off the bank bill swap rate, and much of the short-term issuance by financial entities falls into this category. The other aspect of a bond that you'd need to have a look at is where it ranks for repayment. Obviously, it's a loan, so you need to know whether you're first cab off the rank or last in line before the shareholders. So bondholders usually rank ahead of shareholders for repayment, and this in part explains why shareholders should expect a higher return and why shares over time deliver higher returns than bonds. But not all bonds are equal. Bonds can be senior, which gives the holder first call on any funds in a winding up, or they can be subordinated, or sometimes that's called junior bonds, where they get paid only if the senior bonds are repaid in full. This is common in asset-backed securities, where the underlying loans are purchased with layers of debt. Senior bonds get paid first and usually rate AAA. Subsequent layers get paid later and have lower ratings. There also can be specific assets of the issuer given as security to the bondholder without a formal securitization. And these are often called covered bonds. These are very popular in Europe, where they're known as by the German title of Pfandbrief. Historically, these were illegal in Australia, but were introduced after the liquidity crisis during the GFC. So in 2011, the government allowed banks to issue covered notes or covered bonds while they couldn't access the securitization market. So that's really the universe of asset types that we're talking about when we talk about bonds. And so just as we have indexes for shares, we also need to have indexes for bonds. Now, bonds don't trade in a completely public market like shares do. So, and not all bonds are the same. Like all BHP shares are the same, but not all Australian government bonds are the same. So each tranche or each issue behaves differently. So a bond index needs to consider these thousands of issues of bonds from dozens or hundreds of issuers, and not all of those will be available for purchase at any given time. This means that most index funds need to sample the index, and they try to match the duration and the credit risk, the two big drivers of returns. The most popular index in Australia is published by Bloomberg, and it's a bit of a mouthful, this one, but the Bloomberg AusBond Composite Index. So composite meaning it includes government and corporate bonds. So it tracks a basket of investment grade, fixed interest bonds with at least 1 month left to go to maturity that are issued in the Australian debt market and governed by Australian law. They also publish a number of sub-indexes for specific maturities, but most index funds use the 0+ year benchmark. So you'll find that referred to as the Bloomberg AusBond Composite Index 0+. And it's got a weighted average maturity of just under 6 years and an effective duration of just under 5 years, which, as we said before, when interest rates move, that's a measure of the sensitivity. It's heavily dominated by government and government-related issuers, with just under 10% issued by corporates. So 96% of that is rated single A or better. So we're going to take a break now, but when we come back, we look at how you can apply all of this background to bonds to your portfolio.
This Easy Investing is brought to you by Life Sherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out Life Sherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
Now we're going to turn to applying that knowledge to reap the benefits of bonds in your portfolio. So, starting at the beginning, bonds fit in the defensive asset category. That is, they're in your portfolio not to generate returns, but to create stability and lower volatility. But for some, particularly retirees, they may also be there to generate yield. And there are really three dimensions of how you should look at fixed interest as part of your portfolio. We often call this the bond triangle. And the three aspects, the one most people are familiar with, is the risk offset. That is, how well does this allocation to bonds offset the risk in the rest of my portfolio? And this comes from focusing on high-quality issuers, usually government, and in local currency where the country has an independent central bank, is in control of its currency, and can issue in local currency. So Australia, for example. The second aspect is stability. That is, how well does this stabilise my portfolio? And those two measures are linked to an extent. And stability comes from high credit quality and medium to short term. So the longer the term you go, the greater the sensitivity you have to interest rates. Now, if you think interest rates are going to fall, that's where you might want to position. But if you're simply looking to stabilise your portfolio, you need to be looking in that medium range, which is the sort of 5 to 7 year period. And the third aspect is yield. Now, higher yield comes with higher risk as it necessitates looking at poorer credit quality, longer terms, complex structures, or all three. And like a lot of things in these things, you can choose any two of those three, and the third then falls out. So for most accumulators, you should focus on the risk offset and stability aspects of the bond. So this generally means high quality, local currency, fixed rate bonds with medium duration as your first port of call. As the number of issuers in the Australian market is small, where you need to increase your allocation above 10 or 15%, you should really therefore look overseas to get some diversification among your issuers. And generally, because we're looking for stability and risk offset, you don't want to take on currency risk, and so we'd hedge that back to Australia. Now, historically, Australian interest rates have been higher than global interest rates, particularly the US, so that swapping the currency generally kicked up the yield a little bit. Retirees, or those investing for income, might favour the yield aspect for at least part of this allocation, and that usually will therefore mean moving down the credit perspective and or going longer. And so that's what we should look at. So the risk offset and stability comes from the low correlation with equity. So over the past decade, Australian bonds have shown a very low correlation of 0.25 with Australian equities. Bonds outperformed in 2018 and 2020, both years where the stock market suffered. But interestingly, the same thing didn't happen in 2022 when both stocks and bonds delivered negative returns and bonds suffered worse. Now, that was a consequence of interest rate rises as governments tried to rein in the liquidity created during the pandemic. And so rising interest rates hits share markets because the opportunity cost of holding shares goes up. And it also affects the value of bonds because people demand a higher return and therefore will pay less for the bond. So it's pretty good that low correlation is good, but it's not a negative correlation, so it's not an automatic dampener. But it generally works quite well in low movements. It may or may not cope as well with massive dislocations, where governments can often react by lowering interest rates, which would increase the value of your bonds. So most people will, at least in the accumulation stage, will look to buy their bond allocation through a pooled vehicle like an ETF. If you were trying to construct a retirement income portfolio, you might look at individual bonds in what's called a bond ladder, where you try to align the maturities of your bonds with your spending patterns. But fixed interest is a relatively small, in fact very small, part of the ETF universe in Australia, which probably reflects the popularity of ETFs among young people who are likely to have a lower allocation to bonds. So just $28 billion of the more than $300 billion in ASX-listed ETFs is invested in Australian fixed interest, and even less, just $9 billion in global fixed interest. The real action here in bonds is in the managed fund space, and active management can add a lot of value here, particularly as you move down the credit rating spectrum. In fact, there are just 4 ETFs with more than $1 billion in assets invested in the high-quality end of the Australian fixed interest market. And these are the ones that will be of most interest to those focused primarily on the risk offset and stability features of fixed interest. 2 of these, IAF and VAF, that's the iShares and the Vanguard Australian fixed interest funds, both have more than $3 billion in assets, and they both track the Bloomberg AusBond Composite Index. They both have a management fee of 0.1%, and they both trade on typical spreads of 0.03%. Their performance is statistically indistinguishable, with the Vanguard Fund, VAF, having delivered 6 basis points, that's 0.06% higher total return, not annual return, but total return since 2012 when both were launched. IAF, the iShares version, is 10% bigger, but more importantly, it has a much higher turnover, about 35% a month. And that's why it's our choice when it comes to the high-quality local currency portion of the fixed interest allocation. There is a third one, bond, B-O-N-D, issued by State Street. But this one really struggled to gain traction. Despite being listed around the same time as the others, it has historically had a higher fee, so this recent fee reduction to bring it in line, and a change of its index, it tracks the S&P ASX iBox, Australian Fixed Interest Diversified Zero Plus Index, which is not as popular as the others. And with just $45 million under management, a less diversified portfolio and much lower liquidity, we see no reason to consider it for inclusion in our portfolios. The other 2 at that end are both government only. That is, they exclude the non-government exposure that's in the AusBond index. So you would expect them to slightly underperform on a like-for-like basis. They also have a slightly longer maturity profile, which makes them more sensitive to interest rate movements, which really hasn't helped their performance over the last 5 years. They're both smaller and less liquid than IAF and VAF, so we find it hard to construct a compelling case as to why they should be considered in a core accumulation portfolio. If you're looking to generate a bit more yield, for example, in a portfolio intended to deliver steady income, you're going to need to move up the risk curve or down the credit rating curve, depending on which way you measure it. And this reduces the stability and risk offset functions of the fixed interest allocation. The big players here is CRED, C-R-E-D, that's the BetaShares Australian Investment Grade Corporate Bond. And it invests in senior, that is first ranking, fixed rate, investment grade, rated BBB or better, Australian corporate bonds. And HBRD, hybrid, which is the BetaShares Australian Hybrid Active ETF, which has an actively managed portfolio of hybrids, which are bonds that have some equity characteristics, subordinated bonds, senior bonds and cash. It's run in conjunction with Coolabah Capital, Australia's leading hybrid manager. Christopher Joy is the portfolio manager there. And we've been a long-time fan of Chris in this space where manager skill is paramount. Historically, this has been a great place to be, whilst our banks continue to be strong. But the bank hybrid market is about to close, and the big question mark is, well, what's it going to invest in, and how do we replace the bank hybrids as part of that? So we have this one on watch at the moment, so we wouldn't put more money in. On the floating rate side of things, the big players here are Coupon, that's QPON, the BetaShares Australian Bank Senior Floating Rate Bond ETF, which invests in floating rate notes, which generally tend to be short term, and because the interest rate resets, they have a very low duration. And Sub-D, that's SUBD, that's the Van Eck Australian Subordinated Debt ETF, which invests in investment grade, floating rate, Australian dollar denominated, issued by banks or insurance companies that qualifies as Tier 2 capital for APRA or the equivalent overseas. It's got about 15% overseas. And these probably should be considered more as part of your cash allocation to boost yield at the expense of the stability and risk offset benefits of bonds. So that's the local scene. And as I said, if you need to allocate more than 10 to 15% of your portfolio, you need to be looking at some diversification in your issuers, and that means going overseas. But if you look at the ETF market, if local currency ETF options are limited, global's worse. There is only one global investment-grade bond ETF with more than $1 billion under management. That's VBND, the Vanguard Global Bond Fund. And this alone accounts for half of all global fixed interest in ETFs listed on the ASX. Managed funds are likely to offer a much better solution to most investors in this category. And that sort of brings me to that question that most of our, or many of our members ask, and that is, are members with mortgages and or cash in their offset account question, why should I hold bonds in my portfolio? Isn't it the same as cash? Well, the short answer to that is no. They fulfill entirely different roles in your portfolio. This is not an either-or argument. It's just they fulfill different roles. So cash is for liquidity and for short-term needs, such as your emergency stash or money you expect to spend in the next 1 to 3 years. It's got no prospect of growing in value, and its purchasing power is being eroded by inflation. Bonds, on the other hand, are debt instruments that generate income through regular interest or coupon payments and offer the potential for capital appreciation, providing a higher potential return than cash over the long term, and plays a key role in providing portfolio stability, generating consistent income, and diversifying risk from more volatile assets like stocks. Australian bonds have a very low correlation, 0.19%, with the RBA cash rate, and a slight negative correlation with CPI, so negative 0.14. And the way most people think about this question displays the effects of recency bias. So over the relatively short term, these benefits have not actually played out in practice. So if I look at the 5 years to December 31, 2025, inflation averaged 4.15%. The Bloomberg Ausbond Composite Zero Plus Index delivered negative 0.43% annualised, while the RBA rate averaged 2.64%. A diligent investor willing to move banks regularly and jump through a few hoops might have achieved 1% more than the RBA rate, or let's call that 3.67%. Better than bonds, but still less than inflation. Over 10 years, the story isn't much better, with both bonds and cash underperforming inflation and bonds marginally outperforming the RBA rate but less than our diligent deposit shopper who could have earned RBA +1. The pre-COVID era, though, is much more typical of what you should expect. Over the past 35 years, that's the period the RBA has been targeting inflation, bonds delivered 6.4%, while the RBA cash rate delivered 4.36%, both handsomely outpacing inflation at 2.64%. So as with all things investing, you need to take the long view and learn from the history of markets. Recency bias is one of the biggest curses that investors can suffer from. So wrapping all of that up, that's the bond market. Bonds are there for stability and risk offset in accumulation portfolios. They may also deliver yield in retirement or income portfolios. And cash is not a substitute for bonds. And most portfolios with 80% with less than 90% allocated to growth assets will need some. How much depends on your needs. If you want to learn more about how we apply this information and background to constructing portfolios, head across to lifesherpa.com.au/invest. I'm Vince Scully, and this is Investing.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.